The main factors that contributed to the rise of India's forex reserves to a record high of $595.98 billion as of May 5, 2023 are, the strong inflow of foreign direct investment, FDI, and portfolio investment, FPI, into India's booming economy. India attracted $81.72 billion of FDI and $37.03 billion of FPI in the fiscal year 2022-23, which was the highest among emerging markets. The robust export performance of India's goods and services sectors, especially in the areas of information technology, pharmaceuticals, engineering, textiles and gems and jewelry. India's exports grew by 21.3% to $345.16 billion in 2022-23, surpassing the pre-pandemic level of $314.31 billion in 2019-20. The lower import bill of India due to the decline in global oil prices and the reduced demand for gold and other non-essential items amid the COVID-19 pandemic. India's imports fell by 7.8% to $447.44 billion in 2022-23, resulting in a lower trade deficit of $102.28 billion compared to $157.51 billion in 2019-20. The intervention of the Reserve Bank of India, RBI, in the foreign exchange market to prevent excessive appreciation of the Indian rupee against the US dollar and other major currencies. The RBI bought $88.46 billion of foreign currency from the market in 2022-23, adding to its forex reserves. The valuation gain of India's forex reserves due to the depreciation of the US dollar against other major currencies such as the euro, the pound sterling, the Japanese yen and the Chinese yuan. The US dollar index, which measures the value of the dollar against a basket of 6 currencies, fell by 4.7% in 2022-23, increasing the value of India's forex reserves held in other currencies. Having a high level of forex reserves has many benefits for India, especially in the current situation of global uncertainty and economic slowdown. Forex reserves are external assets that can be used to pay for imports, service external debt, and intervene in the foreign exchange market to stabilize the exchange rate. Let's look at some of the advantages of having a large forex reserve. First, it enhances India's ability to deal with external shocks, such as sudden capital outflows, oil price spikes, or global financial crises. Forex reserves act as a buffer that can be used to meet any unexpected demand for foreign currency and prevent a balance of payments crisis. For example, during the 2008 global financial crisis, India used its forex reserves to inject liquidity into the domestic market and support the rupee. Similarly, during the COVID-19 pandemic, India's forex reserves helped cushion the impact of the lockdown and the contraction in economic activity. Second, it supports India's credit rating and lowers the borrowing cost for the government and the private sector. A high level of forex reserves indicates that India has a strong external position and can service its foreign debt obligations comfortably. This improves the confidence of international investors and rating agencies in India's economic stability and creditworthiness. As a result, India can access external financing at lower interest rates and longer maturities, which reduces the debt servicing burden and frees up resources for productive investment. Third, it boosts India's economic growth and development by enabling greater trade openness and integration with the global economy. Forex reserves facilitate external trade and payment by ensuring adequate availability of foreign currency for imports of goods and services, especially essential items like oil, machinery, and raw materials. Forex reserves also enable India to pursue an export-led growth strategy by allowing the RBI to intervene in the foreign exchange market to keep the rupee competitive and support exporters. Moreover, Forex reserves allow India to participate in international trade agreements and institutions that can enhance its market access and bargaining power. Fourth, it provides confidence to investors and encourages capital inflows into India. A high level of forex reserve signals that India has a sound macroeconomic management and a resilient financial system that can withstand external shocks and volatility. This attracts foreign portfolio investors who seek higher returns in emerging markets like India, as well as foreign direct investors who look for long-term opportunities in India's growth potential. Capital inflows not only augment India's forex reserves further but also stimulate domestic demand, investment, and employment. In conclusion, having a high level of forex reserves is beneficial for India in many ways. It strengthens India's external position, improves its credit rating, enhances its economic growth, and instills confidence among investors. However, accumulating forex reserves also has some costs, such as sterilization, valuation changes, and opportunity costs. Therefore, India needs to balance its forex reserve management with its other macroeconomic objectives and policies. While India's forex reserves have reached a record high of $595.98 billion, they are not without challenges and risks that may affect the country's economic stability and growth. Some of the major challenges and risks that India may face in managing its forex reserves are the volatility of global financial markets. India's forex reserves are largely invested in low-risk and low-return assets such as Treasury bonds, which are subject to fluctuations in global interest rates and exchange rates. A sudden rise in yields or a fall in the dollar value could erode the value of India's reserves and increase its external debt burden.